Okay, let's go ahead and get started tonight. In terms of what we have hopes of covering, I wanted to finish a few items from last week that either time ran out or my mind ran out and I forgot to bring them up. And then after that, we'll talk a little bit about classes and sources of income. We'll talk about elimination of double taxation, which is primarily the foreign tax credit. We'll talk about forms of doing business in another country, if I'm halfway efficient at getting through things. And we'll conclude in the last 10 minutes or so by talking about the case study, which is the series of assignments, and also a discussion case study for next week, which I've emailed you and which I've got a hard copy for you tonight, just so you can more easily look through it. The first one was this case study where we said that X was a parent company who had set up Y. We originally talked about this and we said the facts were at one end of the spectrum, which was that Y in making sales was really only shuffling some paper. And Y was purchasing product from X at 80 and reselling to customers. And we said that Y had no employees of its own. Everything that was done by virtue of employee activity from X. And this was, to use a word that a lot of people like to use somewhat loosely, this was a sort of a sham of trying to just move some profits into Y. And we asked the question, considering this factual situation, what are the mechanisms that we find in a lot of countries where country A can try to grab onto somehow those profits that are in Y? And we said with these facts, we said, well, maybe A has CFC rules. Maybe A could recharacterize the transaction on sort of a substance versus form basis. A could apply transfer pricing principles to force all the profit back into X. And we noted that these three are approaches where country A attacks X. It doesn't matter, in a sense, about Y. It's not, country A's tax authorities are not going after Y. They're beating on X, who is easy to grab from. If country A chooses to attack Y directly, the two issues that we came up with, the two mechanisms, was number one, country A could say that Y is really a resident of country A and subject to its jurisdiction because all the directors are in country A and within reach. And we further said that with all the people doing work inside country A for Y, we said that A could look at Y and say, you have a permanent establishment, you have a business that's being conducted inside country A, we can legitimately tax you on that. So these were the mechanisms. And again, at one end of the spectrum, Y was a shell. And everything, the directors, the employees, no employees, everything's done back in country A with X people. Now, I said, let's go to the other side of the spectrum, the other end of the spectrum, and let's say, how would this differ? So we're going to change our facts. Instead of saying that Y has no employees, we're going to say, yes, Y does have employees and bears the salary cost of those employees. And those employees are knowledgeable and have authority to go out, travel the country, see, negotiate contracts with the customers and see. They are adding value. They are doing the business things that allow Y to make money. And let's say that that price of 80 from X to Y, let's say they have in fact done some work to actually analyze unrelated party transfer prices for similar products and have established that this is a supportable price under transfer pricing principles. And let's say also that the board of directors of Y are people who are different from the people who are directors or important employees of X, and in fact are living in and working in country B. So we look at all of these things and we say, hey, this is a real, legitimate operation. There's no monkey business here. There's proper value added. The pricing is good. Now, if this is the case, that we're at this end of the spectrum, what ability does A have to attack those profits that are in Y? Let's start from the right over here. If what I'm describing is correct, does Y potentially have a PE, a permanent establishment, in country A? Yes or no? Okay, I see you going like this, and I see Peter going like this, so is that, let's take Peter first.
It's just a guess, sorry.
Well, no, but it's a guess, but it must have been based on some logic that you're applying. And there is logic to what we do in here. So think about it. What caused you to say, no, there's not a PE issue here?
Well, I mean, if they're doing most of the work in B, then that's why I thought they would be.
Yeah, exactly. Yeah. I mean, this is not rocket science that we're dealing with. There is logic, and the principles, while maybe daunting from the standpoint of, gee, I'm just getting into this, the principles build on themselves, and there's a very, it's very easy to work your way through this as you gain a little bit of knowledge and experience. So, absolutely. We have said at this end of the spectrum that wise people are working in Y and are traveling to country C to negotiate contracts and do whatever else it is they do, and nothing is happening back in A. So, as a result, permanent establishment is not an issue. So, absolutely right. Okay, what about residency? Is that an issue? Remember, we said that the board of directors were people who are living and working in country B, and they are not important people back at X. Does A have any ability to grab the neck of some director who's sitting over in country B? No, that's right. So as a result, with this new fact pattern, we're not worried about the residency issue. Okay, what about transfer pricing? I said that that X and Y had done, they paid some consulting firm thousands and thousands of dollars to analyze carefully the pricing, and they have nice supportable documentation for their intercompany pricing. Sure, the tax authorities might look at it and say, gee, it should be 83 instead of 80. But we're talking about smaller discussions of what the pricing should be. We're not talking about A telling X, I want 100% of the profit in there because there's no basis to sell for anything less than 100. So of course, transfer pricing is always a concern, but it's not the major concern in the first factual situation. Recharacterization, substance versus form. Again, we're saying there really is substance in here. There really is value added. There are employees. There is a real bearing of the economic cost of the employees and the acceptance of the risk of whether or not we're going to find customers. And we're really taking the credit risk. Y is really taking the credit risk of those customers. So we're not so worried about a recharacterization in something like this. Okay, now let's look at the last one, CFC. What do you think about that? Some of you have taken the outbound course here in the law school, excuse me, and have learned at least a little bit about Subpart F and the U.S. controlled foreign corporation rules. Is there any business purpose test in there that says if you're really doing something and you have an office and real people doing things, that you don't have to worry about Subpart F? Notice that if we use the U.S. rules of foreign-based company sales income, and we think about this, okay, what is foreign-based company sales income? The point of origination and the point of destination is outside the country of incorporation, and the buyer or the vendor is related. Is that our definition, roughly, of foreign-based company sales income? Yeah. So there's no exception for, gee, we really have a valid business operation. Now, why is that? Any ideas? Why wasn't there the usual nice, good business reason for doing something in Subpart F?
I have a question about the fact pattern. So we're assuming Y is related to X.
Right. Y is, that was part of the facts, that Y was set up by X solely for this purpose of routing sales through Y. Yeah, the point is that what Subpart F is trying to get to, and frankly, I've never looked at the legislative history to see if this is down in black and white somewhere, but it's got to be where it came from. The logic is that the U.S., or country A in this situation, is saying if you arbitrarily choose to do business in a manner that puts profits outside of our reach, and you really didn't have to do it that way, it's just your arbitrary decision, then we're going to treat that as tainted income and include it in what gets sucked up through a make-believe dividend to the parent. So if you think about the various categories of Subpart F income, the foreign-based company sales income, point of origination, point of destination, outside the country of incorporation. Well, even though you have a real business operation there, that's still arbitrary that you chose to put it in this location. Now, yes, there's a high tax kick-out, so to speak, exception. If country B is a high tax country, well, gee, I guess there wasn't a tax motivation. But you've arbitrarily decided to use country B, and we'll bring that back. Same thing with services. What's the foreign-based company services definition? Anybody remember?
Related party service outside country.
Yeah, exactly. Related party, somehow involved, and the services are physically performed outside the country of incorporation. Okay. What's the third category that we'll cover here, and we'll forget the rest? What's the big third category?
Foreign-based personal holding company income.
Yeah, foreign personal holding company income. Exactly right. And again, gee, if Y builds up a lot of income from, let's say, successful operations, and then earns passive income, interest or dividends or royalties or what have you, and those are earned inside Y and are outside the jurisdiction of A, then that's rather arbitrary. X could have been a controlling shareholder, could have had Y pay a dividend. But no, they chose to leave all these excess profits down in down within Y. Or maybe X put a lot of assets or more funds into Y than it really needed, and they were put into passive investments. So this is really focusing on categories of income that, in a sense, are arbitrarily placed outside the reach of the home country. So generally, the CFC rules that I've looked at, a lot of them do not necessarily have an active business exception. Some do, but a lot do not. And it gets back to, well, why are these rules there? Number one, again, jurisdiction. The easiest way to grab this is to go against the home country resident shareholder. Get it from him. That's one. And then number two, this idea that we will try to grab what is arbitrarily, with the mind of the law, placed beyond the reach. Okay, there was one item here which I had wanted to cover and I had totally forgotten about. Down here where it says, example, interest withholding tax, Hong Kong branch of U.S. bank loans money to a Chinese enterprise, which applies the Hong Kong-China arrangement or the U.S.-China tax treaty. And to go back to our picture, let's say we have the U.S. here. There's a bank. This, let's say, is Hong Kong. There's a branch of the bank in Hong Kong. There's a borrower in China. And the branch has made a loan and will receive interest back from China. And the reason for talking about this particular situation is that we wanted to indicate just a little bit at the moment about residence for purposes of tax treaties. We will talk a lot more about this subject when we get in roughly the second half of the course to tax treaties, and we'll spend a lot of time talking about tax treaties. But this issue of who is entitled to the benefit of the tax treaty is, I think, an important thing to raise and to see how residence comes into this. Now, we said we have a U.S. bank branch in Hong Kong. Now, again, you should be asking questions. Well, what does it mean to have a branch in Hong Kong? You know, are there people there? Is there office space? You know, are there human beings in it who, in fact, are authoritatively running a business? You know, are they doing something? So, let's, since we are somewhat a little bit limited on time, let me give you those facts so that you have a little bit more knowledge of this. Okay, now, the U.S. bank, which is operating as a branch, has in fact registered in Hong Kong to do business. It has gone through the procedures to get a banking license. It has rented space, and it has real people in there. Some of those people are managers and very knowledgeable in what they're doing and have authority. They take deposits from third parties. They make loans to third parties. They have a real business. Now, somebody at the branch has a relationship with the Chinese borrower, and they have agreed on the terms of a loan. So, from the branch and included within the books and records of the branch is a loan that has been issued to the Chinese company, and under the terms of the loan agreement, the Chinese company is making interest payments. Under the domestic law of China today, there is a 10% withholding tax on interest. So if the interest is 100, then we know that if the interest is 100, then we know that 10 will be subtracted off and will go to the Chinese government. And 90 will be received by the bank. Now, the U.S.-China treaty, if we look at it, there will be an article on interest. And the article, if we read it, we will see that there is no benefit. It doesn't provide any lower rate than the domestic law 10%. So if we have to rely on the U.S.-China treaty, then we really don't gain anything. On the other hand, if we look at the arrangement between Hong Kong and China, now you might or might not notice I'm calling it an arrangement as opposed to a treaty. Remember, Hong Kong is part of China, and a treaty applies to sovereign countries. So to be politically correct on this, we generally don't call this a treaty. We call it an arrangement. However, if you look at it, which I hope you will do at some point during the course, you will see that it looks and smells and sounds word for word like most other tax treaties. So this is the way it is. Now, if we look at that treaty, we find, that arrangement, we find that in the interest article, if I remember correctly, that the rate for withholding on interest is 7% instead of 10%. So if we could rely on this arrangement, we would be looking at 7%. If we have to rely on this arrangement, we're looking at the domestic law 10%. Now, I'm not expecting that any of you have yet taken any time to look at specific tax treaties and see what they say. We will again get to that in a lot of detail later on. But from what we have said last week about residency and the fact that some countries look to place of incorporation, some countries look to place of management and control, some countries look to both. How can we look at this and try to say which treaty applies, or does either treaty apply? Yes, Peter.
I'm thinking it's probably, the company probably has to be incorporated in Hong Kong in order to take advantage of that arrangement. So, in that case, the U.S. company wouldn't be able to get 7%.
Okay, that's good where you're going. I'll suggest, though, a slightly different route. You're first right that you're making an assumption it's excellent. You're making an assumption as to what is in Hong Kong, and I'll talk about that in a moment. What actually is there? But the issue is, if we look at Hong Kong, if we look at the bank and we start out from the U.S., or if we should, let's say, start with the U.S. first, and then look to Hong Kong. What do we say is the U.S. rule on residency? How do we know whether a company is taxable by the U.S. on a worldwide basis? Would a company incorporated in Hong Kong ever be subject to tax on a worldwide basis by the United States?
Part of its incorporation.
You're right. The definition, if you go to 7701, is a company formed under state law or some other aspect of the United States. There's no management control concept in the United States now. It's just country of incorporation. Now, I think I mentioned that, yes, there's been a bill put into Congress, I think last year, which would add a management and control feature, but it's not there today, and there's certainly no, I haven't heard anything that this is going to be coming in anytime soon. I sort of doubt it. But in any case, U.S. country of incorporation. Now, if we go to Hong Kong, very interestingly, for domestic purposes, Hong Kong actually has no definition of resident, because it's not important in the Hong Kong rules. Okay, now if we, as I say, this looks like any other treaty. So we know that Article 4 is the definition of resident. And notice they start out, resident in the case of mainland China means, but that's not important to us because in our example we're only concerned about whether it's resident in Hong Kong. We look to here and we see in the case of Hong Kong, a company incorporated in Hong Kong, or if incorporated outside, then being normally managed or controlled in Hong Kong. So, interestingly, this is one of the few cases that I've run into before where there's not a definition of resident in the domestic law and the term is actually defined in the treaty. This is unusual. So, when we look at that, we now of course have to go back to our example, and does the existence of a branch with authoritative people, remember I said authoritative people are there running the branch, does the existence of that branch cause this U.S. bank to be resident in Hong Kong? When we looked at that definition, was it talking about the residency of what? Of the company or of the branch? Which was it? The company, yeah. And since we're talking about the company, we have to look at the management and control of the company as a whole. Now, have we given you enough facts yet to know whether this branch might be, whether the activities of the branch and the people who are in Hong Kong making decisions, do we really have enough facts yet to know whether the company itself might be legitimately managed and controlled in Hong Kong? No, I haven't. Because we don't know, because I haven't said anything about it, we do not know whether the activities of this U.S. company are major. Maybe this is Bank of America, and this is the Bank of America branch in Hong Kong, and there's 1,000 other branches all over the world of that same legal entity. Remember a while back we talked about the sanctity of the legal entity. So let's assume first, again, to try to put things at two ends of the spectrum, let's assume first that that's Bank of America with 1,000 branches within that legal entity around the world. Well, I think you could be pretty sure that the people in Hong Kong are not managing and controlling that company. So as a result, we would say that the bank is not resident in Hong Kong. It is only resident in the United States. And as a result, we will have to rely on the U.S.-China Treaty. We cannot rely on the Hong Kong-China Treaty. Okay, so far? So we end up with a 10% withholding. Now, let's go to the other end of the spectrum, and we'll say that the bank here is actually a subsidiary of the main bank holding company. Now, let's say that bank holding company is Bank of America, and this subsidiary, which, let's call it X, this subsidiary only has activities in Hong Kong. It has activities nowhere else. And all of the people who run the branch in Hong Kong, they are the ones who have full authority over what happens there. Let's say that a number of them are also directors of X. Okay, now, maybe you do have a basis to say that this U.S. company, which is operating through a branch in Hong Kong, is also managed and controlled in Hong Kong. It's the factual pattern that gives you the ability to say that, yeah, maybe this is the case. Now, assuming you have that fact pattern, there's then the practical issue of, gee, can I convince, number one, the Hong Kong authorities to give me a piece of paper that says, yes, I'm resident, X is resident in Hong Kong for purposes of the tax treaty, or I'm sorry, the tax arrangement with China. And then secondly, to get the borrower who's paying the interest to give him the documents and to get him, perhaps with your help, to try to convince the Chinese authorities that this U.S. bank is actually a resident in Hong Kong and entitled to the 7% withholding tax rate. So the way we have to analyze these things, very fact-oriented. Yes, Peter.
So why doesn't that holding company cause the company to be incorporated in the U.S.? Where is that?
Well, I'm sorry, the holding company is a U.S. company, X is a U.S. company, but is operating through a branch in Hong Kong. That's the legal form. It is incorporated in the U.S.
Okay.
All we're trying to do here is to determine if X can be supported to be a resident of Hong Kong for purposes of applying the tax arrangement between Hong Kong and China. Now, if it could, you could look at this and say, gee, this is a dual resident company. It's resident in Hong Kong because of the management and control there. It's resident in the United States because it is incorporated in the United States, established under Delaware laws or California laws or whatever it happens to be. Okay, we're going to do one more short case study on residency. And I think this is where we had stopped off last time. So read through this for a moment. This is something, this case study I took from a situation which happened when I was working in Shanghai. Some people came in to see me. As I recall, there were the two principals who were Australians. They brought their wives along. It was a nice social event as well. They had one person who was a technical guy from the Czech side, and they described exactly the situation. They said, "Okay, we're going to have this." We're going to have this joint venture in Hong Kong. We're going to be manufacturing certain insulation equipment in China. Well, are we doing it? Well, not really. We're going to provide some equipment, but somebody else is going to do it for us, and we want to have control over the equipment. So they wanted to have a Chinese company, WFOE, which interestingly enough seems to be pronounced by everybody as woofy, stands for Wholly Foreign Owned Enterprise. So that means a Chinese company which is 100% foreign owned as opposed to a joint venture or a cooperative arrangement or something else. In any case, this other unrelated company at the bottom was going to actually do whatever work there was, but using that equipment. The product would be sold to the Hong Kong company, and then the Hong Kong company would resell into Europe. The Australian side was providing, let's say, management and direction. The Czech side was providing technical support and so on. And this is where the joint venture came from. Now, we have to, now we're bringing this up because of residency. Now, we said that the background is that China residency is based on a incorporation in China or management and control. Hong Kong has no relevant concept of residency. Remember I said that Hong Kong has no residency concept in its domestic law. It only has this for purposes of the arrangement between Hong Kong and China. And Australia says incorporated in Australia or managed and controlled in Australia, or voting power controlled by shareholders who are residents of Australia. So if we look back at our picture, do we have some concerns? Well, let me give a little bit more in the way of facts. there's not going to be any employees in China. Also, there will be no employees in Hong Kong. This is what they're telling me. No employees in Hong Kong. Well, gee, who's running this thing? Well, the chief financial officer of the Australian side is the one that is responsible for the paperwork of arranging the purchase and resale, the re-invoicing, so to speak, of the product on its way to Europe. Well, who's managing this thing? Who's directing people what to do? Well, the CFO and then some operating people in terms of, let's say, coordinating with a sales force in Europe. So there's nothing happening at all in terms of activity in the places where the incorporation is. Now, because there was, relatively speaking, more authority to run things in the hands of the Australians, it was rather easy to look at this and say, gee, do you have perhaps a residency problem with this in Australia? Is it possible the Australian authorities will look at this and say that both companies are resident in Australia? And yeah, that's probably a risk. Even if it is not a risk, there's also potential for CFC issues. And another interesting thing about this, what are the economics of this? If Australia were to say that Hong Kong and the Chinese company are both resident in Australia, what does that do to the Czech company? Are they hurt by this at all? Or do they really not care less? Any thoughts?
Probably subject to that.
Yeah, keep going.
The Australian tax, at least like the joint ventures can probably be taxed in Australia, and the Czech Republic has their taxes.
Yeah, no, exactly right. Exactly right. In other words, if the Hong Kong company, which is where the bulk of any profits are going to be, if that company is resident in Australia, 100% of what is in that company becomes subject to Australian tax. It's not just the half of the Australian side which gets taxed, it's all of it. So that the Czech side has a potential extra cost if this thing gets hit. So the point of bringing this case study up is that as you think about any particular situation, be it the client or the company that you're working for or the case study you're working on, do you really know enough? Do you really have to be looking at a big picture and asking what's going on in a larger sense? The typical advisor, whether he sits in the United States or whether he sits in Hong Kong or England or anywhere else, the typical advisor says, oh, you've come in to ask me about Hong Kong and China tax, I'll help you with that. And they have blinders on with respect to anything else that's going on. You have to ask enough questions to be able to say, hey, I'm not an Australian expert, but this sure smells from the Australian standpoint. Whether it's a CFC issue, a residency issue, a doing business issue, because all of this activity is in fact happening in Australia. As a professional, we're not doing our job if we do it with blinders. You don't have to have the answers, but you have to be alert enough to raise the issues. So, yeah, there's an issue with regard to Australia. Do we know whether it's a real, honest-to-God issue or not? No. They never came back, so I have no idea whether they followed up on this or whether they consummated this in the end anyway. But the point is that that's a real issue, and as professionals we have to be getting the big picture so we can recognize issues that might not be within our little area of expertise, but which should occur to us once we see what the issues are, or once we see what the facts are, and therefore the issues. You may remember, I guess last week or the week before, I said that if you've done the first step of the methodology right, get your facts, that with a little bit of experience, the issues will just pop out at you. So this is a perfect example of that. If you've done the first job right of finding out, okay, well, gee, what's going on, who's doing it, where's it happening, then it just is so obvious that, hey, there's all this control from Australia. There's all this activity up in Australia to not only manage but conduct the business of the Hong Kong company. It just jumps out at you that, yeah, there's a residency issue or potentially a CFC issue or something up there. I don't need to know much about Australian law to know that that's an issue. This is what I'm talking about. Now to talk a little bit about source of income. Now, you, whether you took, I would assume, the outbound course or the inbound course, you should have gotten a little bit into your 861, 862, 863 rules so that you presumably will have at least heard of the concept of source of income. The U.S. has some specific rules. Fine. Well, source of income is important for a few reasons, and as a result, it's a concept we find in pretty much every country around the world. So what is source? Just think of it very simply, just as I talked before about jurisdiction being, for our purposes, a simple concept. Source is as well. Where is something earned? And obviously, as we'll talk about a little bit, there can be different answers in different countries. This concept of source, now I put up gross income or net income concept. It occurs to me that not all of you took an accounting degree before coming into this course. You're smiling. Is that because you love accounting and have been studying it on the sly? No. Hurt me deeply. Okay. Well, anyway, the point is that it occurred to me that I'm not sure whether these terms necessarily have a lot of meaning to you. So let me ask, what does, Jasmine, what does gross income mean? What does net income mean?
Net income would be net of any cost of goods sold in terms of accounting.
Okay, well that's one possibility. So maybe our proceeds, let's say, are 1,000. Maybe our cost of goods sold, if we're manufacturing, we would call it cost of manufacturing. If we're just buying and reselling, we might call it cost of goods sold, let's say is 600. Gross income would be 400. Expenses, salaries of salespeople, office administration people, things like that. Rental for the office space, let's say 300, coming down to a net income of 100. Now, this would be something where we're selling goods. On the other, or for example, if we sold shares, or if we sold real property, instead of cost of goods sold, it would be the cost basis of whatever it was we sold, equities or real estate. If we're talking about services, then gross income is the amount you receive as revenue. In other words, whatever the amount the customer pays you, that's gross income. If you're earning royalties or interest or something like that, again, that's going to be the gross income figure. Net income is after expenses. The question that I had asked, or that caused me to do this, was to say, well, is source a gross income or net income concept? If we say, gee, we have interest income from a particular source, are we talking about the gross income of 400, the actual check we got for interest paid to us? Or are we talking about the net income of 100? Gross, okay. And is there some reason why that seems like a logical way to go?
When you're dealing with the source rules, they're probably not residents, so you probably just have a connection to the income and not the person, so you'd be able to know what their expenses are.
Okay, that's good. I'd say that's a good reason, although the source is not only important in the case of how country A taxes non-residents. Source is also important for the foreign tax credit computation. You may recall this formula, which you have to come up with foreign source taxable income. So that normally that's going to be a resident, for example, who is trying to claim a foreign tax credit. But you're right, certainly, that when you think about non-residents, that yeah, it's harder to get the expenses. Absolutely. To me, I think the most important reason is because the location of an expense, the location where you incur an expense, might have nothing to do with the rule which determines what source is. Okay, let's take, sticking with interest for a moment, interest income. Well, what are some possible source rules for interest? Does anybody remember what the U.S. source rule is? I'm not even sure what it is at this point. Anybody remember?
I think it's residents of the payor.
Yeah, that sounds good. Okay, the residents of the payor, and a lot of countries, yes, have that as being their source rule. And generally in tax treaties, the source is the residents of the payor. Are there other possible source rules? Where the money is used? What about royalty? Does the U.S. use the same rule for royalties? Where used. Yet virtually all tax treaties have it based on the residence of the payor. And so, for example, if you have interest income, well, gee, the location of where you might have interest expense, the location of where your office is, and where you're monitoring the creditworthiness of your borrowers, that has nothing to do with the rule that it's the residency of the payor, or where the money is used, or in the case of a royalty, where the intangible property is used. So there's really quite a difference between the nature of the gross income and the expenses which relate to it. Where you are interested, like you are in that foreign tax credit computation, the limitation computation, where that's important, then you'll generally have some sort of expense allocation rules. The U.S. has nauseatingly complex rules, which are found in Regulation 1.861-8. And they're long and voluminous. Take a long time to read them. A lot of other countries will have rules, but again, probably a bit less complicated. Now notice for the application of withholding taxes, because it's on gross income, the country applying the withholding tax doesn't care about the expenses. So an allocation of expenses is not relevant for that situation. But an allocation would be important for example, the calculation of foreign tax credit computation. So why is it important? We've talked quite a bit about taxation of non-residents. The second one, of course, we've talked about some, is the foreign tax credit computation. And lastly, notice that some countries, as we've mentioned, have a territorial system. And very often they will define what is taxable based on what is sourced within their borders. Now, in that case, you'll determine, okay, what income is taxable, and in order to get down to the proper net income for that which is taxable, you're going to have to do an allocation of expenses for that. You have seen, okay, the U.S. rules on in 861, 862, 863. You'll see on these slides, and certainly in the material which you're required reading for the course, you'll see some listings of possible source rules. But what I think conceptually you need to understand and take away from this is the nature of the system that we live within, the environment that we live within, and how it is that every item of income no matter what the label, every item of income has to be put under one category or another. You can't look at something and say, well, gee, I'm not sure what this is. Let's put half in this box and half in this box. It's like you have some number, it differs by country, but some number of defined boxes. Has Company X paid a dividend or has it paid interest? Well, gee, what kind of situation might there be where there's that kind of difference? Well, has anybody ever heard of a hybrid security? A hybrid security. It's a security that has elements of both debt and equity. You're running a business and need some capital. I see if I can find some. But what are the terms that I'm going to pass these two $5 bills over to you? What are the terms? Well, maybe, for example, we agree that, I'm keeping them over here, maybe we agree, for example, that you're supposed to pay me back, but it's only to the extent that you actually have revenues, let's say, from this business that you're conducting. Maybe we agree that you'll pay back 50% and the other 50% is, let's say, subject to real risk. Maybe the interest element is not 10% applied on a compound interest basis, but rather the interest element is defined as a percentage of your profit from the company. Well, I've got some elements of equity risk. I've got some potential for upside gain. But she's supposed to pay me back some. Maybe the payment date is uncertain. Well, what's the nature of what you pay me? Is it interest or is it dividend? Well, this is a question. And you'd have to look at the definition in the particular country of their boxes, their categories for interest and dividends in order to classify it. Now, nobody is suggesting this is an easy thing. Has anybody heard of Section 385 in the U.S. law? You've taken Subchapter C? 385 is rather simple, and as I recall, it just says, well, the Treasury shall issue regulations to distinguish what's debt, what's equity. I may be off by 10 years, but roughly 20 years ago or so, they tried to come out with proposed regulations on this, and there was so much moaning and crying and what have you over this that I think they got rid of it. I don't think there are any regulations under the section. So, I mean, these questions are not easy, but we're practitioners. We're advising a client. We're telling a client what to do in terms of, gee, do you have to withhold on this? At what rate? We've got to make a decision. Which box does a particular item of income go into? You can't be like Solomon and split the baby. So keep in mind and take away this concept that this source of income, categories of income, you're going to have to choose. There's no, well, it doesn't fit here, so there's an all other. Well, maybe sometimes there is, but normally you don't find that. You've got to make decisions. As you can imagine, there's the potential for conflicts that can arise between countries. Country A treats it one way, country B treats it another. That can be a terrible result, or that can be a wonderful result. Depends on the situation. Notice the difference here, the second and third bullet points. In the first one, okay, same category of income, but you have a different sourcing rule in each country. So two countries might treat the same item of income as sourced within their country. And you can certainly have a cross-border category conflict where the same transaction is treated two different ways in terms of what category it's in. By now you should have read through this, so let's see what this looks like. We have X, which analyzes maps of the underground provided by Y. Y is an oil exploration company which has rights to explore and drill for oil under certain pieces of ground, let's say in country B. And X is going to analyze those maps, maybe run them through computer programs, and presumably they're highly trained geologists. And X will eventually issue a report to Y to tell Y, I think you have a better chance to reach something if you drill here as opposed to over here. This is kind of an interesting business. When I lived in Houston a number of years ago, I had a couple of clients that were in the seismic area. And what they did, they had a lot of dynamite, and they had a lot of things that were called geophones. And essentially what they would do is that they would put over the ground at varying distances geophones which would pick up, there's like a microphone, that would pick up the vibrations from underground when they set off some dynamite. Or sometimes they would use very heavy trucks that had vibrators in them that would vibrate the ground, and again, the sound waves or the shock waves from the dynamite would go down, hit off rock formations, reflect back up, be heard by the geophones, end up with a map of what's underneath, and then experts have to analyze that map and say, gee, I think you should drill here. Because if you drill over here and you don't get anything, obviously there's a lot of money out the window. So this is a very high value added thing to analyze these maps. Pretty low tech to actually put off to set off the dynamite and get the initial output, but the analysis of these things was pretty high tech. X receives in country A at its place of business the maps from Y. And the employees of X, they do all this analysis work inside country A. For simplicity, let's assume they do not need to travel to the actual site where the where the underground area that's represented by the map is. So all the work is done inside country A. And Y is going to pay them, pay X for getting a report which tells them where to drill. Country B's domestic tax rules. Notice that Country B treats this sort of technical service, this high-value technical service, and in a manner similar to royalties. So, as a result, the category or box that Country B is putting this payment in is, in a sense, into the royalty box. And their domestic source rule is the residence of the payor. And there's a 10% withholding tax. Now we go to Country A, and Country A says, hey, this is a normal service under our tax situation. We look at this and we put this squarely inside the services category. And as a result, because the rule for services is on source is the location where the services are performed, Country A, of course, would say, well, you perform the services inside Country A, solely inside Country A at your place of business. This is all sourced inside Country A. Country B treated it as a royalty, said it was sourced based on a rule of the country of the payor, and applied a withholding tax. Country A says, okay, this is domestic income. It's taxed at a 30% rate on net income. And if you've paid any foreign tax, we'll allow you a foreign tax credit. And of course, there's a foreign tax credit limitation formula. Let's say that the amount of the charge is 100. Because this is a very high value service, the expenses, total expenses, are relatively low. And as a result, the actual profit element, the net income, is 60. And that reflects this highly technical nature and high value of what is being provided. So Country A's tax is 30% of 60, or 18. Country B's tax is 10%, or 10. And obviously the issue is, what foreign tax credit does Country A allow for this 10 of tax? Now, as we look at this question, let's go in steps. When Country A applies its foreign tax credit limitation formula, whose country sourcing rules does it use? Does it use its own? Or does it say, gee, for consistency, we'll use Country B's rules? It uses its own, absolutely right. Each country is sovereign, and they're not going to look to some other country's rules under normal circumstances for anything. And foreign tax credit limitation is no different. So it's country A source rules. So in this case, how much foreign tax credit will be allowed for the 10 of country B tax? Yeah, none. Absolutely, because we apply the formula, there's 0 foreign source taxable income. So our limitation is 0. Remember, general rule, foreign tax credit equals the lesser of the limitation amount or the actual tax paid. Limitation amount is 0, actual tax paid is 10, foreign tax credit allowed 0. So what is our total tax cost? Country A, taxes 18. Country B, 10. Total tax cost of 28. And that gives an effective tax rate of close to 50%. Again, like with our example 2 weeks ago, gee, that's a terrible result. Terrible. We'll bring up the idea of the potential for a tax treaty to help. You have 2 countries that have signed an agreement between them that they will use common category definitions and common sourcing rules for those agreed category definitions. So if we look as an example at the China-UK treaty, there in fact is a category in the treaty defined as technical fees. And based on that definition, if country A and country B were China and the UK, then you would have this result, that you would have an agreed definition of the category and agreed rule so that both of them are using the same rules. Okay, so in this case, if there is an applicable treaty which does solve the problem, that's great. You will get your foreign tax credit because now your limitation formula will treat, under that sourcing rule that is in the treaty, country of residency of the payor being the source. Now you do have in country A's foreign tax credit limitation calculation 60 of foreign source taxable income. So 60 over worldwide taxable income of 60 times local tax, country A tax of 18 before credit. That gives you a limitation of 18. The actual tax was 10, so that we end up paying 8 to country A. And of course, interestingly enough, when we add everything together, this gives an effective tax rate of 30%, which is the higher of the effective tax rate on net of the 2 countries. 10% on gross was less in this case than 30% of net because the margin, their margin was so high. So we end up with 30%. So no double taxation. Interestingly, tax treaties can help, but they are not always, in fact, helpful. I had to look quite a bit for this last example before I discovered the UK-China treaty. Most treaties do not define a category of technical fees. It just happens to be in that treaty. I don't know what business situation caused the negotiators to include that. But obviously, somebody, I would guess, in the UK had been hit with this kind of thing before and raised it with the UK treaty negotiators, and it ended up in the treaty. But this is not a common thing. Now, all of these other items that have been mentioned, financial leasing, hybrid securities, mergers, thin capitalization, substance versus form, generally treaties do not cover any of these things. And as a result, very often you'll just have different treatment between the two countries, and the treaty does not help. Okay, specific source rules. I'm not going to go through every slide. I just want you to know that the slides are there, scan through them. The idea is that I've tried to list out some of the ways that different countries define source rules for different categories. Gross profit from sale of inventories, okay. Location where the business is carried on could be one possibility. Title, where title passes, that's the thing that's so close to your heart from presumably looking at the 861, 862 rules. Place of order acceptance, where the sales contract is signed. Location where various functions occur, activities. So there's actually quite a range of different things. Now, just as an example of something, this is an English translation of the Chinese source rules. You can see that there's some similarities, some differences from the U.S. rules. The place where the trading activity occurs. No mention of where title passes. In other words, where are the goods physically when title passes? Nothing about that. I'll just put each slide up for a couple of seconds so you can scan quickly. Now, we've been talking about the foreign tax credit, or we've mentioned the foreign tax credit, we've looked at the formula a few times. But now let's step back a little bit and look at the broader issue of elimination of double taxation. there are several types. The foreign tax credit is not the only one as a mechanism which is employed. Another aspect, we'll get to the several types in a moment, but one thing to just note and be aware of. Some countries, at least in my experience, most countries, on a unilateral basis, grant a credit. Grant the foreign tax credit, or exemption, as you'll see. But there are some countries that will only grant a credit where there's, for example, a tax treaty between the two countries that provides for it. So, for example, Singapore for a long time was that way. There was no unilateral credit. I believe there is today, but for many years there was not. And only where there was bilateral agreement was a foreign tax credit provided. The point, of course, is that while you may expect that a country will have a foreign tax credit, you can't assume without checking that, in fact, they do have such a mechanism and that it applies to the transaction that you're concerned about. Now, notice this point on covered taxpayers. You may think that you may expect that normally a foreign tax credit will only apply in the event of a resident of the country, but a reasonable number of countries do have rules that will allow this kind of situation. Let's say your Hong Kong company there, or I'm sorry, not Hong Kong company, the branch that's in Hong Kong is a full business. Its net income is being subjected to tax by that country, in this case Hong Kong. Now, Hong Kong's a bad example, but we'll use it to make the point, since that's what's on the slide. Hong Kong applies a normal tax rate on net income to the net income that that branch earns. Now, if they did not grant a credit for the 10 or either 10 or 7, the 10 of Chinese tax that was paid, then looking at the business that's being conducted in Hong Kong and the tax on that income, that's really not nice to grant a credit. There's really double taxation there. China's taxing the income which Hong Kong is fully taxing. So in a lot of situations, countries will allow a branch that is earning income and that's fully taxable on net income, will allow it to have a credit against the taxation of the branch. Any idea if the U.S. has this provision? I may be wrong, but Section 905 is sticking in my mind. But I know that there's something in there, whether it in fact is 905 or something else, I don't remember. So usually, for example, it's the country of residence. In other words, the U.S. company by the U.S. is granting a credit because they're taxing on worldwide income. But you can also have the situation in the case of a branch. Okay, most common situations where home country relief is needed. We've talked about the very common situation of withholding taxes being imposed on income like dividends, interest, and royalties. And secondly, we've talked about situations where there's a branch in a country, and that branch is, the net income of that branch is subject to tax. And the home country of the company that owns the branch, that home country would grant some sort of tax relief. And then thirdly, we have the situation where there's a subsidiary. Y, let's say, makes 100. Y is taxed by country B at, let's say, 30%. And that 30 is tax that is economically borne ultimately by X, because Y only has 70 of after-tax earnings that can be paid as a dividend back to X. So X will only receive 70. X has economically borne the 30 of tax, but X is not the legal taxpayer. So that's the third item that we're talking about there. So we see some sort of relief from double taxation with those common three items. What are the mechanisms that we find? We've mentioned foreign tax credit quite often, but that's not the only one. Okay, the first is deduction. There may be no foreign tax credit, there may be no exemption, but maybe the country just says, well, we'll treat foreign taxes like any other expense. Does the U.S. allow a deduction for foreign taxes?
Pick.
Yes, you get to pick. You either choose the credit or you choose a deduction. Now, I think usually it happens that companies choose the credit because it's worth more. And we'll show a couple of slides as to why it's worth more, to demonstrate it. Not just say it, but what are the numbers? How does it work? But there could be situations where a deduction is better. What if, I don't know what the rules are today, but it used to be that the carry forward period or the carry back period for operating losses, net operating losses, was a lot more liberal than the carry back and carry forward period for foreign tax credits. Now maybe it's still that way, I'm not sure. But there used to be a very big distinction. And as a result, you might choose to deduct taxes in 1 year to maximize your net operating loss, because, my God, we're never going to use those credits, but we can get some benefits from the deduction. So, yeah, there can be reasons to do that in the U.S. Okay, the second is exemption. Country A just exempts any foreign source income, or defined categories of income, or income that's been taxed by another country, and just says, gee, we will not subject that to tax. Once you've been subjected to tax in the other country, that's it, no more tax in the home country. So there are countries that do that. And then, of course, the third is the foreign tax credit mechanism. Now, probably the most important thing to say that we have not said already in prior discussion is that credits are generally only allowed for income taxes. Either taxes on gross income, on a withholding basis, or a tax on net income. Other types of taxes, gross receipts taxes, value-added taxes, property taxes, these other things are typically not creditable by various countries. And yes, you find all sorts of rules in the U.S. as to how to tell what a creditable tax is. One of the big areas where this was let's say where there was very heavy controversy was in the case of the oil companies. They're taking oil out of the ground in some country, and they have to pay royalties to take the oil out of the ground. And when is a royalty really a royalty, and when is it a tax? The equivalent of a tax that you should get a credit for. And these were very, very big numbers. So years ago, this was a major issue. I presume the rules are now maybe clear enough so this is less of an issue, but there can potentially be situations where something that's not called a tax might arguably be a tax for foreign tax credit purposes. Okay, so let's just look at the numbers using the numbers from the earlier case study where net income was 60 and there was a 10% withholding tax on gross income, which was 10. Okay, if we have a deduction, you see that we just subtract off from the net income. We apply the country A 30% tax rate. We end up with a total tax cost of country A's tax, country B's tax, and we get a total which happens to give us a 42% effective tax rate. Now, how much benefit are we getting from that deduction? The benefit is the tax rate times the amount of the deduction. So we're reducing our tax from 18 down to 15 because 30% of the 10 of foreign tax is 3. So the benefit of a tax deduction, whether it's tax, whether it's salary, whether it's rental, whatever it is, the benefit of a tax deduction is no more than the percentage tax rate times the amount of the deduction. So this is not eliminating double taxation. It's just reducing the amount of double taxation. Now, if we look at an exemption country, they would say, okay, the net income of 60 has been taxed by country B. We will exclude that from income, so our income after the exclusion is 0. Country A tax is 0, and our total tax is the 10 paid to country B. And of course, that's a wonderful answer. And of course, then when we apply the foreign tax credit rule, we get the numbers we looked at before when we did the tax treaty example of, so that the 60 of net income was also the foreign source taxable income. And again, we come down to the 30% because the maximum tax that's paid is going to be equal to the higher of the home country effective tax and the other country's effective tax rate. Now, I'm using that term effective tax rate a little loosely because one calculates its tax on gross income, the other calculates it on net income, but economically one will be higher than the other, one will be lower than the other. And whichever is the higher one, if the foreign tax credit mechanism works right, which it doesn't necessarily always do, but if it does, the higher of the two countries' tax will be the limit of how much is taxed. So this slide is meant to summarize the various concepts that you want to take away. Country of source has the first right to tax, and whatever the country of residence of the taxpayer might grant doesn't affect that. Country B applies its own rules, and that's it. If there's a treaty, of course, maybe the amount of tax is reduced, but it's still applied and they get the first right to tax. Or the country of residence, in the case of the foreign tax credit, will always at least collect its domestic effective tax rate on its domestic source income. The foreign tax credit limitation will not reduce the tax below that level. There will always be at least a full domestic tax at the home country average effective tax rate on domestic source income. Again, notice I say average effective tax rate. If we look at the formula slide, the actual tax before foreign tax credit over the worldwide taxable income is the average effective tax rate in the home country. Now, maybe there's tax credits which reduce the actual tax below, there's other tax credits, investment credits or rebates or something which bring it below the actual statutory rate. So we're not talking about the statutory rate, although that may be what the number works out to be. So this is the typical thing you see, average effective tax rate being what's important. The results of all this, if you have the exemption method, it's taxable only in the country of source or operation. If you have the foreign tax credit, you have tax by both countries, but the total is equal to the higher of the two countries' tax. Indirect foreign tax credit. We have to distinguish between what is a direct tax, what's an indirect tax. We will also talk a bit, and I'll be giving you an example, which in hard copy, which we can look at together, which tries to get to this point that you want to walk away with, which is really why is the indirect foreign tax credit there? Why do we have it there? Why do a lot of countries allow this indirect foreign tax credit? Yes, Andrew?
To put countries that operate as a subsidiary in a foreign country on par with countries that operate as a branch.
Exactly right. And we'll demonstrate that a bit through looking at some numbers. Because this is, understanding why the indirect foreign tax credit is there will help you deal with it when you have to, because understanding the concepts allows you to figure these things out rather quickly instead of getting lost in the detail of the computations and the law that puts them into effect. We're talking about the indirect foreign tax credit, so we need to distinguish what is direct, what is indirect. We said that Y made 100, was taxed 30, and then paid a distribution, made a distribution of 70 to the shareholder, and we'll assume that that in fact is a dividend out of earnings. Now, how much cash actually gets back to X? Well, country B, as a lot of countries do, applies a withholding tax on dividends. Let's assume for simplicity a 10% rate. So that means that of the 70, 7 goes to the government, and 63 makes its way up here. Total tax in country B is the 30 plus the 7, which of course gives a total of 37. The 30 is the indirect tax, and 7 is a direct tax. Why do we make that distinction? Because X is the legal taxpayer of the 7. X is not the legal taxpayer of the 30. But if we want to give if A wants to give X a foreign tax credit for the 30, an amount which X did not pay, although it economically was borne by X, we have to create a mechanism to do this. And this is what the indirect tax credit does. It creates a mechanism to give a credit for that 30. As Andrew said, our goal is to attempt to equate the taxation of a branch with the taxation of a subsidiary. Before we look at the details, why would we want to do that? Why would a country want to do this? Why does country A say, gee, this is a great thing to do. Let's pass a law that allows an indirect foreign tax credit? Are they just being nice, or do they have some other reason?
I guess you want to encourage the success of your domestic companies. In all their activities overall. So if they're
gee, that sounds like it's being nice, but yeah, frankly, you're right. One of the, let's say, basic concepts of tax policy is don't force your taxpayers to do things solely for tax reasons. So be nice, give them a choice so that they can make the best business and legal decision as to how they want to operate. Gee, I have real concerns about limited liability. I really need a corporation. I can't operate through a branch. It's too dangerous from a liability standpoint. Or, gee, I'm going to be doing business in Japan. They don't trust branches of foreign barbarian companies. I have to create a well-capitalized local subsidiary that will be locally respected. Well, these are business and legal reasons as to why you might want to operate one way or another. So the basic tax policy issue is, let the taxpayer decide how he wants to operate. So we get to the same result whether you do it one way or you do it the other way from a tax standpoint. Now, this is the way it works in theory, but obviously when you get to practice, there can be differences. But without going too much into that, the point is there's a reason for this. So understand that reason, and again, things will fall into place and be more understandable. Okay, so first let's assume we have a branch. Now, I tend to draw branches like this. Why? Because a branch is legally a part of the corporation of which it is a part. There are not two taxpayers. Language sometimes can be misleading, and when you use the term branch, it sounds like it's some, clearly defined thing. Well, it's not a clearly defined thing. It's just that there are activities that are being carried out in another country, and it's legally X. The employees are X's employees. Whatever assets are X's assets. This is what it is. So I tend to draw it like this to really demonstrate that it's not a separate entity. And exactly what's included in that branch can be fuzzy. One country might include, in terms of what should be within the branch, some activities that another country doesn't. Okay, so this is our situation first, and now we go back to this. We see, okay, revenue, let's say, is 1,000, expenses are 900, net income of 100. Okay, and using the same figures that I had before, let's assume that 30% tax in country B plus the 10% profit remittance tax. Okay, what's that? Has anybody ever looked at Section 884 in the U.S. rules? Anybody remember what that is? The branch tax? A lot of countries do not have a branch tax. Well, gee, what does that mean? Well, it means that if you operate in branch form in that country, instead of through a subsidiary, then there's no withholding tax because, of course, as a branch, there's legally no dividend that's paid back to the home office. It's just you're moving cash from one pocket to another. You're just moving from one pocket to another. Because legally, what's at the location of the branch is part of that company. So there's legally no dividend, and if there's no dividend, there's no basis for a dividend withholding tax. So again, as a tax policy matter, to equalize things, some number of countries, the U.S. included, and I think the U.S. probably, I want to say, put it into law maybe in the mid-'80s, I think it was before the 86 Reform Act. But anyway, so the U.S. hasn't had the branch tax for that long, but they haven't. And some number of other countries haven't. Canada, I know, hasn't. But in any case, when you have a branch tax, you're trying to, the country is trying to equate treatment of a subsidiary with treatment of a branch. So the tax is going to be 37. Now, when we are looking at this kind of picture, $100, 37, 63. This 37 is all a direct tax. There is no indirect tax. So the indirect foreign tax credit mechanism is just not applicable to this. So looking at our slide here, we have direct tax of 37. We calculate our foreign tax credit limitation. We calculate the foreign tax credit allowed, which is 37, which is less than the 40. And we pay 3 to country A, and we come up with a total tax of 40. And again, in this case, country A's tax rate is 40, which is why we're coming up to the 40 at the bottom. The second column is what happens if we do not have an indirect mechanism. What happens if we don't have that? Okay, we have a corporation, so we're now back to this one. We have a corporation, we have indirect tax of 30, direct tax of 70, and 63 comes up. And the total dividend, of course, is 70. The declared dividend is 70. So now, if we look at the results, we see that the, let's see, okay, the country B tax now is divided between the 30 and the 7 of dividend withholding tax. The country A tax before foreign tax credit is 28. Now, gee, where did we get that 28? Well, how much in this case is the income that X realizes from the dividend? How much?
63.
Well, 63 is whose expense is the 7? It's X. What is shown in the corporate records of Y regarding the amount of declared dividend?
10.
70?
70.
Oh, I'm sorry. Yeah, I'm sorry.
You're forgiven.
Yeah.
Is it to err is human, to forgive is divine? Okay, so 70. Okay, so the taxable income, ignoring any expenses, the income is 70. So we now apply a 40% tax rate, and we get 28. If there's no indirect foreign tax credit, the amount of income that X has earned is 70, the actual amount of the declared dividend. go back to here, and we now say how much foreign tax credit is allowed. Well, what's the direct tax that X has paid? X has paid direct tax of 7. That's it. Since X has paid a direct tax of only 7, its foreign tax credit is limited to 7. So the country A tax payable is 21. Okay, so now the total tax, when we add up the 21, the 7, and the 30, we now get to 58. Which obviously is a terrible answer. So if there's no indirect foreign tax credit, we get a terrible answer. Okay, sort of what's economically behind that? What's behind it is that X economically has only received the benefit of a deduction for the 30 of taxes, because its taxable income is 70. Because that's what it's showing as income. It's received the economic benefit of a deduction, but not a credit. So to give it a credit, we now need the foreign tax credit mechanism for indirect taxes. And now, when we go back to here and we see, okay, well, how do we do that? Okay, if we're going to give a credit for the 30 of indirect tax, then that means that the income economically is the 70 of actual dividend plus the amount of the indirect tax of 30, which gives us 100. Now, I understand you're not accountants, but there's something in accounting which is that the debits have to equal the credits. You've heard of that. Glad to hear that. Well, if you're giving somebody treatment of an expenditure as if they had paid it directly, then that's only one side. The other side is you have to give them the additional income. You have the debit of the tax that you're treating them as having paid, but that means you need a credit of additional income. So if we're going to give X the ability to claim that indirect tax of 30, we also have to increase income. Has anybody ever heard of the Section 78 gross up? I see some nods of heads. Okay, that's wonderful. That's what this Section 78 gross up is. It's just simple accounting entry so that the debits equal the credits. Now, once you do that, you now have taxable income of 100. At a 40% tax rate, that gives you a tax before credit of 40. You've paid a total of 37 of tax, the indirect plus the direct, and you come down to your 3, which is the same number which we calculated as the tax for A under the branch scenario. So this is how the indirect tax credit, in a simple manner, equates to the branch situation. And hopefully gets across as to why we need that gross up that you find in, I think, maybe one sentence in Section 78. Anybody ever think about why the Section 78 gross up is in Section 78 and not in the foreign tax credit section? Ever think about that?
Are those, is that items of gross income?
Yeah. The point that I want to get to, if you've never done it, take about 5 minutes and page through the table of contents of the tax code. And you'll see that there's a logic as to how it's set out and where things are. And it will help you when you go to look for something and you're not sure where it is. There's some logic to how the code is set out. And again, 5 minutes with the table of contents will be worth a lot. Let's just say a couple of words about the Khoo Holdings case study. The idea here is to discuss in class both questions that you would think you need to ask the client so that you have some practice, so to speak, in, okay, well, gee, what questions do I need to ask and so on. And then secondly, secondly, once we have some discussion of what some of those answers might be, what are the issues that sort of pop out that we need to deal with? Now, as you read through this short item, by all means do jot down both questions and issues that you think are there. As you go through looking for questions, remember that questions generally need to be about what is happening, where, what are they expecting to happen in terms of actual operations, what people are going to do. Focus first on those kinds of physical things. And less on, well, gee, what's the tax rate, and so on. Focus on those things. Now, part of the questions also could be, well, what are the tax attributes of the various companies that are concerned? What is the current condition of what their finances are, or how they are taxed in the different countries? That's part of, yes, factual background. But again, while I don't want you to exclude those, I want you to more spend time from the standpoint of just imaginatively and creatively, what questions do I need to ask so I understand the business and the objectives that they have for the conduct of that business. Okay, so that's, again, for class discussion next time. The second one, which is, of course, a little bit longer, the actual description of the case, the background of the case is, I think, is probably shorter, but the rest of it, which is the requirements, are a bit longer. There are 4 parts to this case study. The first part is, again, asking questions. What do you wish to know? And again, operating things, financial and tax status things. What are those things? And what I want you to do for here is to actually put down into an email to me a listing of the questions that you come up with. is take a bit of time and think it through. What do you think you need to know that's not being told you? This is real life. Clients give you very limited information because they do not know what you need. You have this need for a combination of operating information, financial information, legal information on what's happening, where, how, why, contractual, I mean, all of these kinds of things. They don't know what's important. You have to ask. So again, an exercise to practice asking. Now, I will take your questions, and as soon as possible after taking your questions, I will send back to you answers to those questions. And I'll put it into one large file, which will have whatever answers I have. And that file will include, obviously, some information that's important, some that's irrelevant. You know, you ask about something, well, maybe I have verbal diarrhea and tell you about everything, because I don't know what's important to you. So maybe I'm going to tell you more than you need. Well, sifting through and figuring out, well, what's relevant and what isn't, is going to be part of the process. Now, again, at any time during the process, yeah, feel free to ask questions, whether by email or in class. So you know, we can have a dialogue about this. Now, I am asking you to send, this is assignment 1, I'm asking you to send the questions back by April 18th, which I don't remember. The 18th is either Sunday or Monday. Okay. Anyway, again, you know, what I want you to be doing is sitting down, thinking for an hour of, you know, what are the things I need to know, and jotting them down. This is not meant to be a time-consuming task, but use your imagination and creativity to try to come up with the best and most complete list of questions that you can. Now, the second part of the assignment, which will be due on May 5th, again, is going to be a relatively short thing, but I think an important thing, just as a first step, to get you to look at some English language sources for countries of your choice. Review of tax and other incentives available. So you're looking for, well, gee, what tax incentives are there? Now, I don't want you to spend a lot of time looking through and copying things down and putting it in nice form. I really don't care about that. For this, I just want you to be forced to go in and look at things and just list the, you know, in bullet point fashion is fine. What are the things you found? And where did you find it? If you want to put in some detail, that's fine. You can cut and paste. You know, I don't want you to spend a lot of time, but I do want you to physically look at some English language material. Now, assignments 1 and 2 should be done on an individual basis. Assignments 3 and 4, if you wish, can be on a group basis. So if you want to work together in teams, great. If you want to work independently, that's fine as well. So I'm happy with either approach. Any other questions or comments at this point? And I'll look forward to your emails by Sunday.